Very good afternoon to you all, friends. I'm Sanjeev Singhal, Central Council Member and Chairman of Auditing and Assurance Standard Board. I welcome you to this 138th program of AASP for this council year. And today's topic is key consideration in audit of general insurance sector. Friends, the Auditing and Assurance Standard Board is organizing programs on various topics, and that's why this is the 138th program in less than in about 10 months of this board for this particular year. And this year, Auditing and Assurance Standard Board has also come out with the auditing standard checklist and the working paper templates. Kindly use them. And along with the Center for Audit Quality, we have also brought them into the Excel format. And friends, it is my great pleasure in introducing the moderator and the speaker for today. The moderator for today's program is CA Sonia Arora, who has been the past chairperson of Jalandhar branch of NIRC of ICI, and she has been the first women chairperson of Jalandhar branch. And now we have 27% female chartered accountant. So today's panel is adequately represented. Rather, there is 100% diversity, which we have taken into account. Both our moderator and the speaker are female chartered accountants. Sonia has made a stellar difference during her chairpersonship of the Jalandhar branch. That was the COVID year. And I know the way she led from the front, organizing yoga sessions, so many knowledge sessions. I think she did more than 100 programs during her chairpersonship. So that's really, really remarkable. And, probably she has shown the way that, our members and the office bearers should work throughout the year. Kudos to Sonia ji. And of course, our star speaker for the day, CA Padma Shri Cresto, who's very knowledgeable, has been enlightening our members on various topics. And today, again, she's there to speak on the audit of general insurance sector. And friends, in our program, more than 80,000 members have attended these programs so far. And now, given the fact that there are only unstructured CP hours, still more than 1,200 members have already joined, speaks volumes about the interest that the members have in learning about the auditing and assurance standard, various aspects pertaining to that. With this, and I would also like to say that if any of the listeners have an interest in being a speaker with AASP, please do come forward. You send us your recording for 5 to 10 minutes on any subject of your interest in the field of auditing and assurance, and we'll duly examine it. And if found appropriate for taking a webinar, we'll give you an appropriate chance as well. With this, may I now invite CA Sonia Arora for her opening remarks and then inviting our guest speaker for the day. And I will be requesting Sonia ji to take up the questions as and when they are received and ask our guest speaker for the day. Over to you, Sonia ji.
Firstly, thank you so much, sir, for the nice words and always inspiring me to achieve more. Very warm good afternoon to all. We are delighted to welcome you all in this VCM being organized by the Auditing and Assurance Standard Board of ICI, which is being chaired by the none other than the dynamic and energetic chairman, as a CA Dr. Sanjeev Singhal, sir. So your selfless service to the profession is seriously noteworthy and commendable, and everybody agree with me as you groomed us to be a sound professionals too. And today we are fortunate to have here a humble and intellectual female also to enlighten us on the topic of audit of general insurance sector. We all know insurance in this sector requires certain expertise and specialty of skills. We have to inspect the policies, liabilities, risk evaluations, and several other financial records. So today she will be covering the unique risk faced by these organizations and the effective audit plan. Actually, it's really a privilege being a female to welcome a female who have actually attained a lot and extremely done well in her field, encouraging all other women and making us feel proud too. So Padma Shri ma'am is a partner with the audit and insurance practice as MSKC and associate, and also heads the corporate legal functions. She operates out from Mumbai office and has over 20 years of extensive experience in audit services. She is also a part of a global quality review team, and she has expertise in the quality review and standard. She is possessed in-depth knowledge of standard of auditing, both Indian and international, quality standards, methodology, IFRS, company law, auditing standard, INDS, IPO-related matters, and other statutes, and also have expert knowledge of audit tools, including APT. So now seriously, ma'am, your file is so inspiring. So I respect, ma'am, or must say, a lady with a vision to start the delegation. Ma'am, you are unmute. Please unmute yourself.
Hi,
Yeah.
hi. Thank you. Can you hear me?
Yeah, ma'am. It's perfectly audible.
Thanks a lot for the Auditing Standard Board, and thank you so much, Sanjeev sir, as you have always been supportive, and then I think also very much inspiring by your great words. And thanks, Sonia ji, for the warm welcome. And I think this is the second time I am interacting with you on a forum, and it is always delightful. And thanks all the participants who have joined for this session. As I think rightly mentioned by Sonia ji, this is a very niche sector within BFSI also. Insurance is something that's a niche sector wherein we have some intricacies, some terminologies, and some of the things which are very, very typical. I'll try to share a broad overview and important things that we have to take care of when we are doing an audit of the general insurance. I will touch upon a little bit on the appointment of auditors also, and some of the things that we as auditors have to take care of. Can you please confirm that you can see the screen, please?
Yes, ma'am, it's visible.
Yeah. Thank you so much. When we talk about insurance, it's a touchy topic when we claim. But then what we decide to take an insurance is very, very critical and very, very important. And it is always said like the way the advertisements on various media, when you apply for an IPO or when you buy a mutual fund, there is always, there will be always certain disclaimers that you will see in the fine print. So similar is the case with insurance. So when you are deciding on a product, whether it be life insurance, general insurance, when you are deciding, or health insurance, when you are deciding on the product, it is very necessary for you to read the fine print, because there are so many terms and conditions that actually define how you should be taking an insurance. I give very simple examples when members in the team join us, and then when I ask them what is insurance, so I get interesting answers. And as simple as if you break a rule, you won't get a claim. If you actually damage on your own, there are certain things that you won't get a claim. If you take a life insurance, commit suicide within 1 year, you won't get a claim. These are some things which are actually very typical, which are not known by many of the people. The general assumption about insurance industry is, I have paid the premium, I should get a claim, come what may. So people ignore the terms and conditions. One of the things, these are just certain tips that when you are taking any kind of insurance, don't go by the premium amount alone, go by the claim ratio satisfied. All this information is freely available on IRDA website, on various websites and things like that. Don't get only attracted by the premium. Always see the claim ratio that the company is actually catering to. So if a company is catering to more than 97, 98% claim ratio, your premium is going to give you the claim. If the rejection ratio is almost 15-20%, there's a high chance that there are rejections of that. I'm not saying here who is right or who is wrong, but you have to be careful in evaluating these factors. These are very, very essential. Second, whether you are going for a life insurance product or a health insurance product or general insurance product, please understand what you are buying. So when we go to a shop and buy something, for example, we buy a mobile, we understand the configuration, the features, And what is our use? If I play games more, my mobile should have good capacity to actually process faster, and my display has to be good. If I'm using only for Outlook, PowerPoint, and things like that, maybe I have to buy a bigger screen. That is my need. If I'm using it only for calling, maybe even only a button phone would do for me. So what is it that I'm buying? It's very necessary to know. So insurance industry is classified into 3 to 4 pieces. One is general insurance, which comprises of fire, marine, hull, and the motor insurance. So motor is everything ranging from a insurance on a bike to to a tractor, everything, lorry, truck, tractor, everything. That is motor insurance. And non-motor is everything else, which is marine, hull, and things like that. Life insurance, we all know, inside life insurance, there are various types of product. You have pure term, that is you have to die to get the claim, in simple terms.
Really apology to disturb you, interrupt you, ma'am. The slide is not moving.
No, I have not changed the slide. I have not changed.
Then it's fine.
Yeah. I thought I'll give a 5-minute introduction and then go to the slide.
Perfectly, sir.
Yeah. So then life insurance is something where you have different types of product. Pure term combined with some benefits, money back, cash back kind of policies, and then also the ULIP products. So ULIP products are unit linked insurance products also. And there are various conditions attached to all these kinds of products. Then the third sector, which is also kind of general insurance sector, is the health sector. Health sector, there is a total boom in the industry because of whatever happened in the last 3 to 4 years. People have suffered badly because they did not have health insurance in terms of when they get admitted to hospitals and things like that. And then there is a B2B, so all these are B2C. And then there is a B2B sector, which is reinsurance. So what is reinsurance? We will also look at that. Some of the terminologies that we should understand when we go to the insurance industry, we will have a look at that also. Now, I think this is the table of contents, whatever we are going to, cover largely. The concept of insurance is what I was talking about. Overall, insurance industry in India is governed by IRDA, which is the Insurance Regulatory Development Authority of India, which is in Hyderabad. And there is a, one very important regulation. We will talk about various regulation. One top-notch regulation of IRDA is protection of policyholders' interest regulation. So whatever violations which doesn't get covered under, so this is like a general penalty clause of Companies Act. Whatever that doesn't get covered anywhere, any violations by any insurer or reinsurer, it doesn't get covered under anything else, it will get covered here. So this IRDA, government regulatory body, is striving to protect insurance policy holders. So any kind of policy holders, if they have grievances, addresses, redressals, all these things are looked into by the IRDA. It's first, there are levels how you escalate your claim also, and then you can ultimately go to IRDA as well. So before opening up this sector for private players, industry consisted of only, 2 state insurers, life insurers, which is LIC and GIC. Then there were some government PSU sector insurers like NIC, which is National Insurance, National Assurance, Oriental Insurance, and things like that. Then later on, the sector was open to private insurers. And then we have 58 insurance companies operating in India, out of which 25 are in life and 34 are into general insurance business. So this is a quick snapshot. But still, penetration of insurance sector in India is only up to 4.5 to 5% only. These are some quick statistics to show where does insurance stand. I have picked it up from one of the Invest India government website, just to provide insight into it. The insurance premium volume stands at 127 billion as of 21. Life is 76% and non-life is 24. There's a huge scope for non-life still. So there are lots of products that are available in the market. Motor is one thing which is commonly known, but there are many other products also which are available. For example, professional indemnity, which we all chartered accountants should have. Then there will be, burglary, theft policies. So there are various products that are still available. Health insurance have started doing well from the last couple of years. And because of the things that has happened in the health sector, the premiums have also gone higher a little bit. Total insurance premium in India increased by 13.5% in 21 as against a global revenue of 9%. This is actually at the start of the COVID, but in 22-23, this is one sector, you can say all other sectors were, kind of hit by COVID, but this sector also gained. However, it was nullified by the amount of claims that they got as well. So when you have increase in premium, you have increase in, because of the unfortunate incidents, there was a large amount of claims also on many of the insurance companies. Premium volume in 21 was 97 billion of life insurance, 30 billion of non-life insurance. The growth in business premium, the growth in new business premium is 17% in 23. This is financial year 23. There was a $45 billion additional business in the life insurance. All these statistics are also available on IRDA website. Still, we have a lot of scope to get more people insured. As of now, it is 5 to 6% is what is estimated. India's share in global insurance market was 3.23% in 21. So it has registered a year-on-year growth of 10.2% in 22, with new business contributing to 45.5% of total premium received by the life insurance. What is new business? New business is new policy with a company. So if the company is able to attract new customer, it is new business. And the second leg is renewal business. So premium is classified into NP and RP, which is new premium, new business, and renewal premium. Okay, so that is one of the concept that is there. This is the overall concept of insurance industry. There is an insurance company, say ABC Limited. So to be an insurance company, it's not a simple case, as you know. It needs 100 CR capital. Solvency margin has to always be maintained at 1.5. There has to be good backing, and then it needs a detailed evaluation as to whether it can be established as an insurance company or not. It has to be a public unlimited company, a public unlisted company, or it can be a listed company as well. Both is possible. There is insured, which is ABC Private Limited. ABC Limited, not Private Limited. There is insured. Insured is the person or the thing that is insured, the person's name in which it is insured. So there will always be a continuous communication between the insurance company and the insured. So they give premium to the company, and insurance company gives back claim if the conditions are satisfied. Business, when we do the financial statements, we classify the insurance company balance sheet into business areas and non-business areas. What is business area? Business area is premium, commission, okay? All these are business area. Reinsurance is all business area. What is non-business area? It's mostly claim, investment. All these are called non-business area generally. Then, on the basis of the premium, there is a percentage that is already decided. There is a commission regulation, and then the commission is paid to the intermediaries or the brokers, you can say. So there can be a corporate broker, there can be bank assurance as a channel, or there can be any other kind of individual broker as well. Few terms to understand. Number one, premium. Premium is something that you pay in terms of, the company receives this as a revenue in terms of the risk that they are taking. So if they receive a premium of say 1,000 rupees, they are actually calculating how much risk I am taking against 1,000 rupees. Maybe the policy is for 5,000. Okay, the policy insured is 5,000. So we are talking about general insurance here. So it may be health or it may
Recording
and
in
I have given a
progress.
policy of 5,000. Then what I'm doing is I will pay reinsurance premium of say 400 rupees and I will pass on some amount of risk. So either full or partial as the case may be. However, for the insured, it is always the insurance company whom he will deal with. He has got nothing to do with the reinsurance. It's an arrangement between the insurance company and the reinsurance. That is what it is, B2B. And reinsurance generally falls into the general insurance sector only. So that is how either for each policy or on overall basis or on excess of limit, excess of loss basis, the treaties are made, reinsurance treaties are made. A portion of commission is given, a portion of premium is given, and a portion of risk is transferred or full risk is transferred. So if I have a portfolio of say 500 crore, I am earning, say for example, 100 crore as my premium. I am passing on, for example, premium of reinsurance premium of 25 crore, and I'm proportionately passing off, for example, some to 150 crore as the reinsurance. So that is reinsurance ceded. This is the term reinsurance ceded. Similarly, there are some companies who have to again fall into certain criteria and they have to fulfill certain criteria. They are eligible to accept reinsurance. So someone else can give it to them and they can accept reinsurers. That is reinsurance ceded and reinsurance accepted. When you cede the reinsurance and when you give a premium, you get a commission on that. Now coming to commission, whenever you receive a premium, if it is not a direct sale by the company, and if it is actually coming through any of the channel, which can be a bank assurance, or it can be a broker, it can be a registered entity, whatever, you pay a premium. There is a limit on premium on motor and non-motor also. So when you provide this, then you also provide commission. So you take business from them and then you pay commission as per the regulation. Now, when you pay reinsurance premium, the other party gives you reinsurance commission. So you earn 1,000 rupees as premium, you pay 400 rupees as commission. On that, you will earn say 30 rupees of commission again. And when you accept reinsurance, you end up paying some of the reinsurance. When there is a very large, very large subject matter to be insured. For example, this generally happens in fire and marine. You have to insure a full ship, which can be say 3,000 crores, 2,000 crores and things like that. Then the concept of co-insurance comes. So it is like a consortium. So what you do, you pull in 2-3 insurers. One of them become the lead insurer and rest of them become followers. So all the terms and conditions, everything gets agreed with the lead insurer, and then the rest of the people also pitch in. So if the total risk to be covered is 2,000 CR, they will divide the risk in the proportion that they have agreed as per the treaty. And also they will get the premium also in the same proportion. So lead insurer receives and then he gives to co-insurer. This is the overall arrangement. So this is lead insurer, co-insurer. This is about the premium and the reinsurance and also the commission. Now, when something has to be taken as a risk, okay, we have to insure, for example, a car. You're buying a car from the showroom. So the dealer offers you 4 to 5 options. You can go with company A, B, C, D, E. You will choose a policy. Now there are various types of policy. There is something called in motor, you have something called as motor OD, motor TP. That is own damage, third party damage. Means you have damaged your car on your own or someone else has damaged. So TP is generally, third party is generally a court case, FIR and things like that. And court decides the claim at times. Then OD is generally when, you know, you accidentally hit somewhere, something happens, and then you give it to insurance and get it done. And also there are comprehensive policies. There is only certain component coverage policies. There is coupled policies, all these different type of additional, you know, roadside access, things like that. So there are multiple things that are there in the products, and you can choose any of these products. Similarly, fire, premises with certain things, without certain things, marine with all the cargo in it, and things like that. So there are various products available here. Health insurance, everyone knows. You can take it for yourself, you can take a family floater, you can take a combined one, you can take it for specific, you can take it for a number of things. So these are the type of products that exist. When we are taking this risk, when the company is taking this risk, there is a very important step called underwriting. What is underwriting? Underwriting is a process where actually the risk that you are taking, you are actually evaluating whether it is appropriate or not. So basically what the person is seeing is that whether that 5,000 is appropriate in terms of 1,000, or at times you will see that the premium actually goes up because the risk is higher for the insurance company. You sometimes end up seeing this, that he got a policy for similar car for a lesser premium, I got it for more. So it may be the city which you live in. There are a lot of factors, geographic, demographic, and many other factors. The horsepower of the car may be different. The model may be different. BS5, BS6. Now BS6 is the latest one. So there are multiple permutations, combinations based on which the premium gets decided. So when you actually pay the premium, it is always proposed premium. And when the policy gets issued, it is the final product that is sold for the premium. These are certain terminologies and these are certain things that we have to understand, which are very, very typical for insurance company. I still remember that, when we go to the audit of any of the insurance company, I think many of us had this experience. People from the company ask us, have you done it earlier? Because otherwise they will hold a orientation session to actually explain us the concepts. So I think that also becomes very necessary at times if we are doing that. And if we don't know these terminologies and if we don't know how these complexities work, then it becomes pretty complicated on where do you audit and how do you audit. Because one of the things that is very necessary as per standard of auditing is knowing the business of the client. Unless you know the business of the client, you won't be able to appreciate what they are doing, and you won't be able to actually justify or do a proper audit of that entity. So knowing the business is very, very important. So knowing these typical terminologies are very important, and that is why I spent this 15 minutes on just the concepts itself or some of the typical terminologies itself. There are more terminologies, but then these are very, very essential or necessary. Regulatory framework. This is a very tightly regulated environment. Insurance business is not loosely regulated. It is quite tightly regulated business. IRDA is always at the helm of the things, and they are evaluating everything whatsoever possible for the protection of the policy holders. We have an Insurance Act. We have an IRDA Act under which the IRDA is formed. Then there are various regulations. I have tried to, capture few of them, which are very, very important. Not all of them. There are at least, I think in GI, there are 47 regulations or so. I've captured 10, 12 of them, which are very, very critical and very important. Payment of commission, remuneration, rewards to insurance agent, insurance brokers regulation, expenses of management of insurance transaction, investment regulation, then insurance advertisement disclosure, appointed actuary regulation, then preparation of financial statement and auditors report, very, very important. Reinsurance regulation, surveyors and loss assessors regulation, outsourcing of activities. When we are doing an audit of a highly regulated entity, one of the very important thing is we should know the sections and the regulations properly. It is very necessary for us to understand what we are doing and whether we are doing in terms of compliance with laws and regulations as stated by that laws and regulations applicable to the company. Also, because of code of ethics, you have this NOCLAR, and insurance sector comes under PIE, public interest entity. Even though it is unlisted, if few of the companies are unlisted, they are still PIE. And also it is one of the category of NFRA coverage also. So insurance is very much as a PIE and NAFRA client, NAFRA category. It's very important that we understand the insurance sector well before we start the audit. We have to spend adequate time to understand the regulations, to check the nuances of these regulations, and like doing back
Recording in
direction or
progress.
the other. For example, last year there was a change in this commission regulation. There were certain changes in the investment regulation. So it's a completely regulated industry, and we have to always keep our eyes and ears open for regulations. For example, payment of commission, remuneration, and rewards. So this lays down certain limits, overall limits, individual, this change of rewards policy. What are the things that you have to look into? Insurance brokers, registration, non-registration, when he becomes valid, invalid, whether he has passed the exam, whether he is eligible to be a broker. Then expenses of management, will come to expenses of management a little bit later, as this is a complicated area. IRDA investment regulation. So investment regulation are, it's a kind of many limits are there. Overall limit, per sector limit where you can invest, then per group limit where you can invest. So these are system built commands in most of the insurance companies because it is not possible to manage it manually. So testing of these things becomes very important. Another thing that we have to note is that the application data or the policyholder data is always rested on another application, and the financial information is generally on other information, something like a SAP, ERP, or in-house developed information, right? So there will always be an interface, and there will be too many controls in the company. One, because BFSI, second, because the number is very large. So it will be mandatory for you to use IT experts or ITRA experts or IS experts, as you call it. It will be necessary to involve them because there will be one application on which all client data will be there. That is, policyholders data will be there. Financial system will not have policyholders data. When you go to any branch and pay a premium, that actually gets transferred to a premium suspense account, and when the policy gets issued, it will get converted into the income, and then it sits in the financial system. So 99% is that you will have batch processing at the end of every day. So it is necessary, it becomes complicated. And then there are control accounts which actually keep getting nullified every now and then because that comes from one account to the other, then it gets transferred. So there will be these control accounts reconciliations that you will have to continuously look at. For example, premium suspense account reconciliation, reinsurance reconciliations, and all these are also necessary to look into. And the IT systems. IT systems will be complex because either it will be within the company developed IT system, or it will be a complicated system that is available in the market that they have bought. Now, similar to bank, insurance company will have to keep all your records from KYC to your health records, to your declaration form, to your proposal form, to all the previous records, current records, everything. So the application process will be quite elongated, and your financial system will capture only the financial related data. So involvement of IT experts, involvement of IS experts, IT auditory. You can't do away with it. There is no company that will have a non-complex IT system here. Okay. So these are some of the very typical nuances which you will always have to take care of. Then there is this insurance advertisement disclosure regulation. Advertisements have to be whatever advertisements are issued, there are guidelines how they can issue advertisement, because this is very sensitive, and they cannot wrongly advertise for the personal gain, and they have to maintain an advertisement register in which everything has to be noted down. Then you have appointed actuary. Now this is a specialized area. There is Actuarial Institute in India, from whom whoever has completed the course, every insurance company has to have one appointed actuary. It is mandatory as per IRDA, and these appointed actuaries play a very vital role in terms of product pricing, in terms of reinsurance, in terms of calculating the treaty losses, in terms of calculating the liabilities on the policy. We will come to those liabilities also. So these are quite complex area, and how do we report on it? We will speak about that as well. Then you have preparation of financial statements and auditors report of insurance companies, which is a very, very typical one, and Schedule 3 doesn't apply to IRDA, to financials of insurance company. There is a fixed format of financial statements, as well as there are certain things that are to be reported in the audit report as well. So these are governed by these regulations of financial statement preparation and auditors report regulation. As we spoke about, there is a reinsurance regulation also as to how to do it. So there are certain concepts within reinsurance, something like a obligatory reinsurance. So when you enter into a treaty, there can be a portion that every policy that you get, you will do a obligatory reinsurance. For example, 5%, 4% is something that's obligatory that many people enter into. Then there is something called as quota share, that is over a certain quota you will be sharing some of the things into reinsurance. Then there will be something like a sliding scale commission. Sliding scale commission is something that over a period of time, based on how you have achieved your business, or what are the things that you have promised and how much will you share as reinsurance, you will calculate at the end of the treaty. It gets on overall basis and it gets settled there. So treaty is generally for 3 to 5 years, and there will be amendment with reinsurance. So there will be a sliding scale commission also. So all these things, the terms and conditions of the business gets determined by the business contracts. However, the basics of the reinsurance is captured in the IRDA reinsurance regulations. Then insurance surveyors and loss assessors. So one has to be a surveyor license or loss assessor license if he has to. For example, there is a accident that has happened. So the surveyor has to go there, assess everything, and look and determine the amount of loss for the insurance company to actually to process the claim. For example, in case of fire, in case of floods and things like that, generally this loss assessors or surveyors play a very important role. They go and assess, and then the final claim is, a decision on the final claim is taken. Outsourcing activities, there are certain activities like bookkeeping, regulatory piece, underwriting, and the reinsurance processing. These cannot be outsourced by the company. So these outsourcing regulation talks about what are the functions that can be outsourced by the company, and how the outsourcing agency has to function, in the sense, before appointing any vendor for any outsourcing. For example, payroll. The company is outsourcing payroll, and the company is outsourcing certain document verification to some other entity. So these things, they have to first do a due diligence. There are these processes that are laid down, and also it says that you cannot actually outsource anything and everything. Claim processing you cannot outsource. You cannot outsource the underwriting business and things like that. So these outsourcing rules also play a very significant role. So this is the regulatory framework in short of the insurance company. And few others, we have in the preparation of financial statements and auditors report, it's into four pieces. Part one is accounting principles, part two is disclosures, part three is general instruction for preparation of financial statement. There is something called as management report that we issue along with the financial statements. And then part 5 is the format and the preparation of financial statements. Then there is another part on the auditor's report, what all is necessary to be reported in the auditor's report. A quick glimpse on who is eligible to be appointed as a auditor of insurance company. And one of the things very significant to note is that right from the time of privatization and even before that, insurance company is always into a joint audit scenario. Insurance company will always have two auditors, joint auditors, and further, the number of audits that any firm can take is limited to 3. So we can only take 3 insurance company audits at any point in time. That too, we can't take all the 3 as general or all the 3 as life. We have to have a combination of maximum 2 general plus 1 life, or 2 life plus 1 general, like that. And we cannot do more than these 3 entities as statutory auditors. I'm not talking about there are other audits also as per IRD Act, which are like IRMS audit and then concurrent audit and of investment and things like that. So there are some conflict of interest also provided, like banks here, but maximum we can do 3 insurance company audit within the network of the firms. The firm has to be in a continuous practice of at least 5 years. Minimum of 4 partners before the date of appointment. At least 1 partner has to be CISA DISA. 1 partner should be a fellow member. 1 partner has to have 3 years experience in cyber security, information security, or either insurance company or bank or mutual fund. 1 partner should have experience of audit in IT environment and conducting audit from remote location as well. Auditor or audit firm should not have been banned or declared ineligible or fraudulent by any of the respective regulator, like Government of India, State Government, IRDA, SEBI, RBI, ICI, certain SFIO, anyone. Certification under IRDA cyber security guidelines do not recognize management representations only on the basis of reliance. You have to have more detailed information with respect to that. The auditor is required to maintain all the details, and regulated entity, before issuing the engagement letter, obtain relevant details from the insurer as well. So there is a Form A declaration which we have to provide to IRDA for appointment. So one of the typical features of IRDA is that you want to appoint appointed actuary, there is a form. You want to appoint a director into the company, there is a form. You want to infuse capital into the company, you have to ask IRDA. You want to make management, very senior management changes, you need to go to IRDA. You want to merge the company into somewhere, you should go to the IRDA. If you want to sell some shares of your company, you should go to IRDA. You want to take some, so this is a FDI route, right? So FDI was released up to 49%. So taking FDI, still you have to file a form. So everything is just covered by IRDA, and without permission of IRDA, you can't do anything. And on routine basis, IRDA does 2 to 3 types of inspections. One is inspection of the financial statements on annual or biannual basis. Largely it was being done by annual basis, and then there were comments that used to come to the company on certain disclosures, on uncertain reportings and things like that. That used to be a common feature always. Then second is they sometimes do thematic inspection. They may actually come and inspect only one area. For example, premium. Generally, they take complex areas like reinsurance or EOM. That is, EOM is not emphasis of matter, that is expense of management here. So EOM verification or investment verification. So they will have these thematic inspections. Or Third one, once in 2 to 3 years, they do elaborate inspection of they have lot of data. So monthly basis, insurance companies have to submit a lot of data. That is, you have to submit your monthly statistics, new insurance premiums, new business premiums, NBP, RP, everything you have to keep submitting. And then the amount of claims, the claim turnover ratio, how the claim got repudiated, how the claim actually got lodged, and things like that. There's a lot of data that on monthly basis, quarterly basis, companies keep submitting. Over and above, when IDA comes for detailed inspection, they actually go into the data, the source, the application, they threadbare look at everything, assumptions, all the things they look into, and then they conclude on the inspections. And then they have the powers to levy penalty on the company as well. Okay. Some of the key areas and its auditing aspects. One is claim. Insurance claim, as you know, you go to the company and then you lodge the claim and then you sign the form. There are some documents that are necessary. So how it happens in short is claim is lodged. They take it, they acknowledge the claim, and then they look at the policy, they look at the terms and condition, then they look at what is the damage suffered. Overall basis, what is the claim that is tenable, not tenable, and then they decide on the amount. And based on hierarchy within the company, they have this table that up to 2 lakhs, certain person can pass the claim, up to 10 lakhs, someone 1 crore, someone 2 crore, someone, and things like that. So the claims get passed. And in case claims are rejected, the claims are rejected on with proper details and with proper, replies. If they do not actually record the reason, and then there has to be a claim committee, and there is a grievance committee also. Now the claim, when it gets repudiated, they have to record proper reasons why that claim is not tenable and getting repudiated. Any person who is aggrieved by the claim has to actually can raise a request to the company, and the claim committee can again look into, and they have the right to accept the claim or reject the claim. And then if the person is still aggrieved, he can go to IRDA. Now, what is to be verified here as an auditor? So the TAT is important here. The companies have these policies. So overall on policy protection for regulation, TAT is already fixed. With generally the companies have a lesser TAT than that, and then we have to see whether what is the point at which they are actually reserving. So for every claim that gets registered, system automatically reserves a certain percentage. Now, what is the percentage? What is the basis? These are the things that we will have to evaluate. Say 100 rupees claim is lodged, company has a standard policy, 60 rupees is provision that is made already in the books. Okay, now why 60, why not 50? What is the history? These are the things that we have to audit. Then claim, when it is lodged, some of the dockets we will have to check to see whether all the documents are available or not. That is another thing. Then third thing, what is the amount of claim? What is the statistics? Where is the rise in the claim? What are the reasons? These analytics we will have to do. Then the fourth thing that we have to do, what are the number of claim tally? That is opening number of claims resolved during the year and repudiated during the year, closing number. And then reporting to IRDA. We have to cross match with reporting to IRDA. These are the factors. And then the claim committee. What are the basis for rejection? Then the next step is there will be some legal cases here. Then the independent legal confirmation, or you have, because the number is quite large. Many a times what they do, because of the number of outstanding cases, they will decide a ballpark figure based on the experience and estimate, and then they will make a overall provision for the claim. So what is the basis of that? How did that percentage get arrived? Say 500 claims and 500 cases are going on. So they make on the basis of, based on premium, average claim of certain percentage. What is the basis of that? What is the percentage of that? Then over and above, there is another thing called as outstanding claim. For example, there are some claims which are lodged, but then company has asked for some KYC, some additional document. No one is providing that. So the company keeps following up. And there is a clear mandate that the money has to be paid through NEFT only. So the bank account details are not there. So there will be outstanding claims. Some people lodge the claim, then something happens, either they forget or something happens to them and the claimant doesn't come back at all. So these kind of cases also happen, and there will be outstanding claims. So IRDA has an additional regulation that you have to continuously monitor the aging of these claims. If it is more than 7 years, then it goes to something like an IEPF, which is again investor protection over here. Okay, so these are the things that are actually on overall basis the audit of claims that we do. Analytics in claims are in form of how many claims, where, when, demographic, geographic, and what are the reasons. Some of the things we also have to keep in mind is that if there is a natural calamity, for example, recent last week floods in Chennai, something like that will give rise to a claim. So that is one thing that we will have to keep in mind while auditing these areas, because these are the specifics wherein claims will go up. For example, health insurance industry. 2 years ago, lots of claims due to COVID. So genuinity of claim. Then IRDA was also saying that please dispense the claim as soon as possible. Don't make people suffer. So those things will obviously, the volume will increase. Then your verification will have to be looked into more in detail. The portion on IBNR and IBNR, I'll come to when I come to the actuarial slide. Then the main revenue source, premium, which is actually, if you talk about it, is largely governed by IFRS 4. This is one thing that is going to change in the near future. There's a new standard IFRS 17, which is getting implemented across the globe. The principle of IFRS 7 is mostly on the principles of of IFRS, Ind AS 107. So it's 109, sorry. It's largely on the terms of financial instruments, and then you have, spreading over the income and things like that. So the impact over there will be very heavy in life insurance business, because you pay premiums for long term, you have benefits over long term and things like that. But mostly general insurance, the policies are short-tailed. That is 1 year to 3 years policy. In between, there was this two-wheeler insurance which had come up for 5 years. But apart from that, generally the policy is short-tailed here. Okay, so premium. So the company develops a product. So we will take a step back and look at company develops a product. So actuarial team as well as the sales team gets together, they develop a product, or the company, and then the company, there is a regulation called file and use. So you have to file the features of the product to the IRDA, and you have to start using it, and then IRDA may come up with certain questions on how does this product work, what is it, you have to change this feature, this is not proper priced too much, and things like that. You have to tweak it at times, but otherwise you file it and you start using it. So once that is done, then there will be underwriting, right? Whatever I am taking as a risk, whether it is appropriate or not, there is an underwriting regulation. Two types of underwriting. One is called as black box underwriting, which is largely standard, which is actually coming up from the system itself, which is a standard case. If 5 conditions are fulfilled, so the policy gets issued immediately. If there is any problem anywhere, then it is actually goes to manual underwriting also, and certain levels of approvals also. Then manner of receipt of premium. So as per IRDA, as per section 64 BB of Act, no premium can be recognized. No risk can begin before the receipt of the premium. So receipt of premium is mandatory so that the risk can begin for the premium for the insurance company. So your corresponding many a times due to year-end, month-end pressures, there are lots of policies that are underwritten on the last day and things like that. So your cut-off testing and all have to be very careful. You have to be very careful. There is also a practice in some of the companies to issue something called as a cover note, and the insurance policy comes later. So you have to check whether the risk has begun before the premium has been received or not. So that what we call as money to policy, policy to money reconciliation. That for every money that is received, policy is issued, and for every policy that is issued, money is received or not. So that reconciliation becomes very important. Over and above everything, we have the protection of policyholders' interest regulation, which is the supreme in terms of IRDA, in the eyes of IRDA. There is advance premium. when you are booking a car, for example, you generally end up paying the premium before the car gets delivered to you, because you make all the payment and the car comes to you. Till the time your risk doesn't begin, it will be advance premium, and it will be allocated. At that time, the proposed premium is, say, 10,000 rupees, or sorry, 30,000 rupees on a car, for example. Now the premium comes to 28,560, something like that. Then that 1,760 has to be refunded to you. It cannot be held by the company, otherwise it will go into unclaimed. So unclaimed is not only where claimant didn't come, but also the excess of all these policy amounts, everything also goes into unclaimed in a way. So that they will have to refund it to the respective person. That's advance premium. So this advance premium comes as a dump. It's individually available in the other system, in the application, but in the financial system, advance premium comes as a dump, say 1,000 crore at one time, sorry, 100 crore for 1 month or something. Then allocation from there happens after the next batch processing based on the proposal number. There are multiple fields like proposal number and things like that. So when the proposal number, against that proposal number, a policy gets issued, then in the next batch processing, amount moves from advance premium to premium. Okay. So till that time, advance premium is a liability for us because we've received in advance. It is like customer advance. Then unallocated premium. So premium deposit, that is advance premium, and premium which is received for which risk has not yet commenced, that's unallocated premium. So this happens mostly in case of renewal premium. So you pay before the date. Your policy expires on say 25th of December. But insurance companies actually tell you that if you pay by 15th of December, you will get 5% discount, you will get this benefit, that benefit. So you pay there. So then your policy gets renewed from that date. So for this period, it is still sitting in unallocated premium. Now that also happens on the basis of next level batch processing. So there will be control accounts for all this advance premium, unallocated premium, which you will have to look at the aging. You will have to see how are the things moving. At any point in time, there should not be too much accumulation in any of these accounts. Generally, the lead period is 25 days to 2 months. So beyond 2 months, nothing should be sitting in these accounts. That should be one of your check, for example. So these are the types of checks you need to have this. And when you are receiving advance premium, you have to look at the accounting as well, and the moving from the advance premium to the premium and unallocated premium to the premium. These are the things that you have to look at. Next thing, unexpired risk reserve. Unexpired risk reserve is actually, it's an accounting concept. It is used to estimate the amount of unearned premiums that the insurer has yet to incur. For example, if on 31st of March, you have 5,000 policies, out of which 4,300 have been renewed, and then there are 700 policies which are yet to be renewed. So you recognize income for them, you recognize commission for them, and there is a reserve for which this premium is to be reserved. So that is the additional amount that you actually, for the matching concept, you will additionally incur. Premium deficiency reserve is if this premium, if this claim comes up, then what should be my overall premium? So in a way, during the expiry period of that, or on overall basis on unexpired policies, there is a reserve that gets created wherein the premium is towards depletion. However, a possibility of claim may be there. Now what IFRS 7 will bring in this change is that all this premium will have to be amortized over a period of time wherein the risk is spread, and also all this unexpired risk reserve and premium deficiency reserve, that is we call it as URR and PDR, this has to be spread over such period. So these will be the accounting aspects that will actually change over a period of time. We spoke about 64 VB compliance, that is risk to start only after receipt of money, and money to policy premium, policy matching, and policy to money matching is something that we have to do. Risk start date is very, very important. That is the date on which risk starts. For example, there are cases where you have paid a premium, but your risk has not started, but something happens, then you are not eligible for a claim. you are at the most eligible for refund of premium. There are some cases like that. So that is why we say that, always check what is the start date, what is the end date of the policy, what are the terms and conditions of the policy. Risk end date is the date on which the risk assumed by the company ends. Underwriting, we spoke about. Document testing is something, we have to do on routine basis, docu-check. Right, all the policies, policy dockets, receipts, underlying documents, claim documents, everything. We generally do that as doc check, right? Commission. Now, commission is mostly automated area. Very minimal, I think, other than provisions, very minimal intervention, human intervention. So when, as you know, there are regulations for broker, certain percentage is there, for individual certain percentage. Say for example, in motor TP. So motor TP, you have 22% as the standard premium that you are recognizing. Now you build it into the system. Every time you put up a policy for 100 rupees, map a broker, it will automatically generate 22 rupees as the commission payable to that person. So when the batch processing happens from advance premium, allocated premium, and overall premium to the premium, immediately system runs another command to recognize commission out of this premium. And when out of this premium, you actually look at reinsurance, and when you pass the entry for reinsurance, there will be another command which will actually generate reinsurance premium. So that's how it largely works. This is most of the time automated. Now what happens is that generally you have got a 30-day grace period for some of the policies like health insurance and all. You have 30 days grace period to pay the premium. So what the company does is, on the assumption that you are going to continue, it actually accumulates the premium. Now when it accumulates the premium, commission also gets accumulated. And if the renewal doesn't happen, there is a reversal of both the elements. Okay, so that is called clawback of commission. That is one of the terminologies again there. So largely that is how commission works. Few things very, very important to talk about in commission is that there is a recent change in which the regulated percentage is more liberated. Now the capping is on overall basis instead of individual basis. We have to comply with IRDA payment of commission, remuneration and rewards regulation. What are the things to check in commission? Whether on recognition of premium, commission is getting generated, on recognition of reinsurance, commission is getting generated, or otherwise. That is one important check. On non-renewal, whether the clawback is happening is the next important thing. We will have to do a sample checking on the basis of, registered brokers, agents. They will have to give a generally exam to pass, and then they will have to have a broker agent. Now, whether the license is valid or not valid, no insurance company is supposed to pay any commission to a non-registered or unregistered broker at all. So that regulation is important. Then outstanding commission and analysis of that, aging of that, why it is outstanding, why it is not paid, and things like that. That is very necessary. Any provision in case of write back, or provision in as the case may be, in case of any commission, that is another area to be verified. So that's about the audit of commission per se. So regulation, percentages on overall basis, and verification of these reversals are very important to be known. Next is investment. One of the completely system driven things. Investment can be done, again it is governed by a regulation. Key consideration is rate testing of securities, in which securities are made, in which investments are made. So first of all, they can invest anywhere, from equity to mutual fund to bonds to debentures. There are restrictions on where they can invest. They cannot invest in substandard instruments. They have to be investing in AAA, AA+ and kind of instruments. Then there is a classification where it will sit, how it will sit, we will look into. classification of investments into long-term and short-term, and then exposure to a certain group is something we have to check. Custodian confirmation, generally all this information in investment area is handled by one or the other custodians. There are many banks which provide these kind of services. So it will be largely handled by those custodians. A few of the things that we will have to very specifically check is, how the investments are being made. Now let us take a step back here. You receive a premium of 100 rupees. Then out of that, there will be some management charges and other things, depending on the product and depending on certain things. After that, the rest of the amount gets invested. Okay. First of all, that flow has to be seen. Where is how much is getting invested? That's very important. After that, then you will have to see the investment policy of the company. There has to be an investment committee in the company. Investment committee determines the risk appetite of the company. There is a risk management committee also of the company. Now the risk management committee determines the risk appetite. Investment committee participates in it also. They determine which are the type of securities we are going to invest in. For example, a company may say that I will only invest in government bonds. I don't want any risk. There may be companies which say that no, I want to invest in bonds also. There may be companies who say mutual fund also, equity also. So it depends on the risk appetite of the company. So they will take the money and they will go to the market and then they will invest. So when they invest, there are certain caps here. Percentage of investment assets, these percentages will have to be maintained at all the points without any exception. So central government securities at any point in time should not be less than 20% of the total investment portfolio. So if I have 100 rupees, this cannot go less than 20%. It can be always more than 20%. You can even invest 100% into government securities, but it cannot be less than 20%. Central government, state government securities or other approved securities, not less than 30%. So category 1 central government is 20%. If you take state government, everything together, it's not less than 30%. Again, you can invest 100% in only category 1 and 2. Okay, it is not less than. So you are not supposed to refrain yourself by saying this is only 30%. It is other way around. It cannot be less than 30%. So no one can stop you from investing entire 100% into these. Approved investment as specified in 3AB and other. So approved investment, there are some categories. Mutual fund go into approved securities, AA go into approved securities. So there are categories defined. And other investments of Schedule 2, prudential norms, exposure norms, there are those kind of IRAC kind of norms which are there in bank. Equivalent to that, there is in insurance company also. Exceed more than 70%. Now, first 1 and 2, what we saw is it cannot be less than 20% or 30%. Now, what we are seeing in the third category is this should not be more than 70%. So you can never exceed 70%. So there are limits and fatal limits that are set inside the system. Generally, the system works like the dealing team generates the deal ticket. Then first it checks the limits and then it checks the re-release of the categories. And then if it is viable, available limit, then it processes the transaction. Otherwise, there are fatal limits which truncates the transaction itself. So that's how the system works generally. Other investments subject to exposure norms, which should not be more than 15%. Actually, that should have come below, and that is not more than 15%. Housing loans to state government for housing and firefighting equipments by way of subscription, investment in housing, all these things put together, investment in infrastructure, all these things, not less than 15% of the total assets. So all these limits have to be, some of the limits are overlapping. You have to calculate these limits. Now, what are the things that you will audit here? First is investment committee minutes, risk appetite of the company. Then which are the investments they are using into, they are doing into. Then the third thing, then the next thing is all these limit verification. You have to do all that, you have to be having someone very good in Excel or some other tool like Idea, AS or something who will do all this analysis for you. You have to have someone like that. Then the next thing is sale purchase of asset, which is a sale purchase of investment, which is a daily affair. So you will have to map the rates from the bhav copy if it is equity investment from the respective websites, NCDs, non-NCDs, government bonds. So the respective OENDA sites or other sites where you can pull the data from. Then download the custodian statement, look at for the holding and the trading as well. Then relevant approvals for dealing in various types of securities. And then on overall basis, whether all limits are getting complied with, or if there is any, marginal difference, or if it is leading to any fatal error. Again, this being a complicated system-driven area, participation of IS auditor cannot be ruled out, and these things, certain things will have to be at least the IPE testing, that is a information produced by the entity, certain reports and things like that. These will have to be tested by the IS auditor. So these are the things that you will have to do. If the entity is also doing certain investment in mutual funds and things like that, then from the respective websites, you will have to verify the NAVs, valuation of those things and all that. So these are elaborate audit procedures that you will have to do specifically. Next thing is reinsurance. We spoke about reinsurance, that this is sharing of risk. Basically, you are sharing the risk with someone, and in turn you are providing some of your premium also. In turn, you are getting the commission. Things that are to be tested here is reinsurance treaty. Reinsurance treaties are not simple. They are very, very complex. You have to go into the reinsurance department and you have to sit and understand and note down, make a synopsis of this treaty and understand how the logistics work here. Because as I said, there can be quota share, there can be obligatory, there can be sliding scale and all this. So these are not things that you will be able to calculate easily, or you will be able to assess easily. All these things are quite complicated. So you need to go and sit with them, and then you will have to understand what are the things and how does it happen. And when those things you look into, you will understand, and then you will have to, the next thing is you will have to test all those things. So number one, make a synopsis of the treaty, look at the terms and conditions, evaluate the terms and conditions, and actually come to conclusion that whether those things are being implemented or otherwise. Then look at the obligatory ceding, accepting, the quota share, what is the amount that is ceded, accepted, as the case may be, and then the premium that is shared, the commission that is received. Then the other leg of it, you have given premium to them. So when there is a claim on that policy, you will pay the insurance company will pay the claimant. However, it will recover also from the reinsurance company. So at cases, so there are instances where the reinsurance company sometimes, based on certain conditions, rejects the claim. But the insurance company must have already paid, or it is in the process of paying. So there are some fights, some tussles over there also. So these things also you will have to cover. Another important thing over here is it's mandatory to take reinsurance confirmation. So you send a confirmation, receive the confirmation. It's mandatory. It will take some 30-45 days to cross tally the amounts and things like that. But then it is mandatory to take this reinsurance confirmation. This is very third-party confirmation, which is actually comes quite handy. And you have to do that. Then co-insurance, as we spoke about. So co-insurance is, as we said, that there will be a lead insurer and there will be co-insurer. So there are certain things that are actually provided by the lead insurer, and then there will be share of that premium that will come to the others. So things to verify here, again, the treaty between the agreement or the treaty which can be between all these co-insurers and insured. You will have to check that. You will have to verify the terms and condition. And then even in co-insurance, it's the same. When a claim comes, everyone shares together. So those are the kind of things that you have to verify. Now, one of the things IRDA has started is that with respect to reinsurers and co-insurance, there is a system on which you will have to upload all these things, and then this has to tally, because so balances with insurance companies, with other insurance companies, is something that is on the basis of co-insurers and reinsurance. So you will have to actually tally those things appropriately. That becomes very, very necessary. The next largest area is expense of management regulation. If you all know, there were a few years ago, there was on this mutual fund front load, management load, and things like that. So this expense of management regulation is kind of similar to it, not very similar, but then kind of similar to it. What happens in case of expense of management regulation is that the application regulation is like Rule 17 D for general insurance. The expenses in insurance company is completely regulated. So there are two accounts, right? So one is technical account, one is non-technical account. We'll come to that. So whatever the management is incurring expense, there is a certain limit to it based on the number of years the company is in business. So there are different slabs: 1 to 3 years, 3 to 5 years, 5 to 7 years. So if you are in that slab, then the expense that you can incur of the management are different, which you can charge to the policyholder's account. Over and above, everything will have to be borne by the shareholder. So that expense of management regulation will have to be completely, what do you say? You will have to abide by. And expense of management is favorite of IRDA also, because when you have policyholders account and when you charge excess expense of management, then they may be deprived of the benefits that they are there. So say, for example, if there are some policies which will be eligible for certain bonuses or things like that. So if you excessively charge expense of management, then those bonuses may not flow into the policy holder. And that is why this expense of management is very necessary. So the total expense as such will be 30% of GWP is allowed to be sitting in the policyholder's account in case of general and health insurance business. So you have to calculate it on the basis of each LOB lines of business, that is motor OD, motor TP, fire, marine, hull, and things like that. And then you will have to others, and then you will have to allocate it on the basis of that. So all the excess that you get above the designated percentage of the people who are there in the business on the basis of number of years, that will have to be transferred from the policyholder to the shareholders account, because they have to bear that in excess. So there is a UM certificate also at the year end that will have to be provided to the IRDA. And this is a very critical calculation. And if this goes wrong, your financials may be having a true and fair view, means impact on the true and fair view. Then the next one is solvency margin. Solvency margin. So things that you will have to verify in expense of management before we go to solvency margin is you will have to see the what are the expenses, how they are allocated, and how they have calculated the excess, and then how it is getting transferred to the shareholders account. It is necessary to verify all these aspects very carefully because there may be repercussions from IRDA. IRDA looks into the inspections of these very specifically, and this is their favorite area, and they come up with a lot of observations here. So they ask auditors also to explain how they have verified at times. So it is an important area to look into. The next thing is solvency margin. So when we are talking about solvency margin, it is very important to note that the solvency margin is something that actually can make or break the company, in other words. So in order to be in the business, and especially in the insurance business, where there is this protection of policyholders regulation is of highest importance, the company has to be solvent to the extent of 1.5. So how to calculate solvency margin? There is a solvency margin regulation over there, and there is a things that are mentioned. For example, in balance sheet, what are the items that you can allow and what you can disallow? So it is like net worth calculation, but it is over and above net worth calculation. So there are certain items that you will have to disallow. For example, any receivables from other insurance companies more than 9 months, you will have to disallow. So there are list of things like that. Easiest way to verify this is take the regulation, plot it into a checklist, and then verify each item, because there will be workings for each of these items, and then there will be regrouping of these items for the purpose of solvency margin, and ultimately the solvency margin is arrived at, right? So ratio of actual solvency margin to required solution solvency margin should be 1.5. If at any time, if it goes below 1.5, the regulation says that the registration itself of the company may get cancelled if it doesn't make proper plans to refill the solvency, right? So this becomes a larger audit point, because I think everyone tries to maintain the solvency margin at all times. It is, if you're doing limited review also, we generally check the solvency margin at all points. This becomes a going concern issue if there is no solvency available with the company, because that's a major hit to the company. In my experience, I've not seen many such cases, but however, this is very, very important in terms of overall determination of how the company is doing. Financial statements. So we have revenue account, we have profit and loss account, right? So this is very typical. Revenue account is technical account and profit and loss account is non-technical account. Another name for it is revenue account, technical account, and policyholders account. And profit and loss account, non-technical account, shareholders account. So everything that the shareholders invest in, whatever shareholders deal with, will be in P&L. Everything that you receive as premium, commission, all that stuff, reinsurance, everything will be in revenue account. This is very, very typical. And then you have the financial position, which is the balance sheet. Revenue account is split into revenue is split into three pieces: fire, marine, miscellaneous, marine cargo, marine others, miscellaneous, motor, ODTP both, workman's compensation, engineering, public product liability, aviation, personal accident, health, weather, crop, others. So these are the classifications of revenue, various LOBs, what we call as lines of business. So these are the various LOBs that we have, and this is the classification, how the schedule gets broken into. The presentation of financial statements are guided by the IRDA regulation, preparation and presentation of financial statements, and the auditor's report is also guided. So largely the framework is SA 700. And then there are certain things that IRDA wants us to include under legal and regulatory. So over and above 143(3) of the Companies Act, we also include certain matters in the auditor's report as well. So very typical things that we will have to take care of. Technical account and non-technical account. Technical account will have all business sides. That is business with outsiders, you can say. That is the premium return, premium earned, losses incurred, losses paid. All these things will be, that is benefits paid or losses paid, whatever you want to call it. So all these things will be part of your technical account. Underwriting income or loss, as the case may be. Loss and loss adjustment expense reserves that we talked about, a few reserves, URR and PDR, UPR and PDR. Then reinsurance recoverable, investment income, and then any dividend to the policy holder. All these things will become part of the technical account. Then non-technical account is before we go into the non-technical account, what is it that the shareholder does here? Basically, shareholder has bought in at the beginning of the company, has bought in 100 crores. Every time when the business increases, he has to ensure that the solvency is managed and maintained. So we'll have to keep pumping in the money. Generally, the gestation period for insurance company is told to be 6 to 7 years, at least 8 years. Okay, still 7 to 8 years, all your to maintain solvency margin, shareholder has to keep pumping in money. So investments out of the premium and then out of the shareholders' investment also. So there are certain investments out of the shareholders' money also. So the investment is actually split into two pieces, Schedule 8A, 8B, right? So 8 and 8A, sorry. So what happens is whatever amount comes in, it is in the proportion of shareholders' funds and policyholders' funds. It is split into two pieces: shareholders' investment and policyholders' investment. So shareholder at all times, shareholder in terms of, at all times, in case of an insurance company, is supposed to make good every loss that the policyholders account incurs. Okay, so whatever shareholder pumps in, excess money is all kept in shareholders account, and then whatever relating to premium is kept in the same proportion as the policyholders investment. So technical account, as we saw, directly whatever premium is received, reinsurance is done, ceded, accepted, commission, benefits paid, everything comes and sits in policyholders account. And then there are other expenses. For example, your litigation, penalty, all the penalties and whatever, violations, if at all done, all administrative expenses like KMP salary, director sitting fees, IRDA registration fees, MCA fees, all these directly go into shareholders expenses, shareholders account, which is non-technical account or the profit and loss account. Okay, so if there is a loss in the policyholder account, it gets transferred to P&L. Okay, over and above all these admin expenses, all these legal and other expenses get charged to the shareholders account, and then shareholders will have to absorb it. Then the net one goes to the respective schedules. So there will be investment income which is pertaining to the shareholders account. Then there will be certain other income, if at all, which is not directly related to the core insurance operation. For example, rental income or something. That if it is directly attributable to the insurance business, it will still go to policyholders account. Otherwise, it will come to shareholders account. Operating expenses, cost associated with day-to-day operations of the insurance company, just as administrative expenses, salaries, marketing cost, all that come and sit in. So now these costs are not directly debited to shareholders account. What happens is, say 100 rupees is your cost. 100 rupees is first debited to policy holders, and from 100, whatever is over and above the EOM, that is 30% is of GWP is calculated. For example, your GWP is say 1000 rupees, and if your total expense is 400 rupees, 30% of 1000 is first calculated, which is 300. So over and above, all the spillover is taken to the shareholders account. Other than that, legal and other fees, everything gets debited to profit and loss, and also the income taxes, okay, based on company's taxable income, then net income or loss, and then shareholders equity, cash and cash equivalent. All these things actually come in non-technical account. Okay, so when you have to look at the balance sheet of the insurance company, first go to revenue account, look at the company's business, then come to shareholders account, which will give you a maturity analysis and solvency analysis as to where the company is standing. Then this is a specialized area. As we said, every company has to have actuary, appointed actuary. Some of the things that the actuary does is right from the product pricing to the reinsurance to many other things. These are some of the very expert things that they do. IBNR, which is incurred but not reported. Now this is in relation to claims. IBNR is incurred but not reported. Then IBNER is incurred but not enough reported. Okay, and then PDR is premium deficiency reserve, and UPR we discussed. Now what is IBNR is that, this is an actuarial estimation that claims are incurred but not enough reported. So that means the incurred but not reported. That means at the end of the period, there may be some claims which are actually sitting there, but which have not yet come to you. For example, accident has happened, but it is not yet reported to the insurance company. So there is an element there. And then incurred but not enough reported. That means there is a loss of 100 rupees. But however, as on today, the estimation has come for 40. There is an additional estimation that is possible up to 60. So these are actuarial assumptions. Now actuaries go through a very complex process of assumptions and things like that, which can be a matrix of 150 by 200 conditions or something like that. There are specialized softwares for that. which actually calculate all this, and then actuaries make those assumptions and derive at these losses. Now, these are IBNR, NER, and PDR and URR or something that actually only actuary certifies. And as per IRDA audit reports regulation, what we can do is that we can put a other matter paragraph, because we are not experts. We have not tested this. So that is why we put a other matter paragraph in audit report of insurance company. We state that I have not verified. This is done by an expert and has been relied by upon us. However, as per use of expert standard, management expert standard, certain basic things will have to be done by us, evaluating appointed actuaries forms, evaluating certain data that they process. We will not be able to process all the data that they process. And then understanding the assumptions and documenting those, at least understanding whether there are any change in assumptions and whether that has lead to any additional reserve or any release of reserve. Those things generally we do inquiry processes, and then we document these things. This is the audit procedure that is necessary for these things. Then general things is that we have to do a thorough planning. There is another area which is IRDA inward and outward communications. I think I forgot to wrote that. I had written that somewhere. Yeah, it's there in the regulatory compliance. Okay. Yeah. So when we are talking about IRDA, there are continuous communications from IRDA on the new policies, procedures. There are certain specific instructions that are given to the company, and there's a regular two-way communication with all the insurance companies. So one of the important things when we are auditing insurance company, we should definitely look at IRDA communications, both inward, outward, thoroughly, and then see if they have given some instructions, whether these have been passed, and they also find out certain things and they point out certain things. And then in IRDA inward, outward, we also have to determine whether those communications have an impact on the financial statements, require any adjustment and things like that. And that will have to be thoroughly documented as well. While planning, few things we have to keep in mind. Gain an understanding of the business. What is the type of business? What are the typicalities? I've tried to explain many concepts here. Risk assessment, identify, because we do audit as per SA 315. We need to do a thorough risk assessment, and we need to identify the risks. And we should ensure that, appropriate risks are identified, controls are mapped. Now, obviously, IFC is applicable to all these companies. As we already discussed, IS experts are required, IT audit experts are required. So, because the systems will be complex, all this should go into planning. We cannot close planning without these things. Internal control evaluation, review of risk, review of internal controls, then documenting these control procedures, because you'll be able to do only control-based audit approach here. You won't be able to do only substantive procedures here. You have to do a control-based audit. So understanding the controls very much in detail will be mandatory. Substantive testing, you can test some of the financial statement assertions for substantive testing. You may have to look at some of the dockets in terms of the premium, claim, anything. As it is joint audit, you will always end up doing half of the business. That is either, generally the distribution is like business, non-business. That is, someone does operating expenses, operating expenses, premium, commission, operating expenses, someone does, and the other person does claim, investment, and things like that. So you have to look at that. You will get the half of the balance sheet, but then there is also necessary. It is also necessary as per SA 299. You should have a joint EL. That's mandatory. You should have responsibility allocation properly. You should ensure that TB, all the accounts are properly split. It should not happen that we think that they have done it and they think that we have done it. There has to be a continuous communication with the joint auditor. It is necessary to discuss any observations that you have on their areas or vice versa. So all these aspects have to be in minutes of meeting with the joint auditors, with the company. All these things have to be appropriately captured. Premium and claim testing we spoke about very much in detail. Reserve testing is through inquiry-based approaches that we discussed. Regulatory compliances, largely we talked about the solvency margins, the compliance with the various regulations. We need to continuously read here so that we are updated and so that we cater to the audit in the perfect sense. because if we do not study here, if we do not read here, if we miss out something, then IRDA can definitely come behind us. Investment reinsurance, investment and reinsurance. Investment, we talked about the portfolio, we talked about the valuation, classification, talked about how to verify. Reinsurance contracts, we talked about the the treaties, the validations, the verifications. Then management representations, very, very necessary on various aspects, as well as, from actuary, you get a actuarial certificate also. You need to obtain that IBNR, NER certificates also for your files. Reporting, audit report as per SA 700 plus IRDA regulations, certain matters to be reported under 143(3), and then the management report that we spoke about, that's a specific management report that we have to issue as well. So that's a separate UDIN as such. Follow-up procedures, post-audit, you should conduct a post-audit or debriefing review to understand where is it that you have done well and what are the things that you should have done well. And then also look at all the IRDA inspection reports for any lacunas or any additional observations. Communication should be continuous. Now, insurance companies will have all types of committees. Reinsurance companies as of now in India are new, but they are small. Other than that, all insurance companies will have all the committees: risk management committee, investment committee, protection of policyholder committee, grievance committee, and lots of committees. You should ensure that you go through all these minutes of meetings, you make notings, you cross-check with the financial statements. Overall basis, you should analyze, understand, and close on all these findings together. So that's very important to tie all the loose ends together. Then obviously finalize all these things, look at the presentation as per the preparation and presentation guidelines of IRDA, and collate everything and then close your file. So this is, I think, in a glimpse about, audit of general insurance companies. We can have questions if at all we have for the next 10-15 minutes. I think I tried to cover a lot of aspects, which may be, I can say they are complex, and I have been able to touch on the surface on many of the things, but I try to cover as much as possible. Yes, of course, there are lots of things other than this also. And then when you get a deeper dive into the ocean, you will unearth more factors. But kind of try to cover the entire balance sheet and the audit for the important areas. Sonia, over to you for any questions.
Thank you so much, ma'am, for the insightful deliberation, I must say. And for such an interesting topic, we are having queries too. Most of have been covered by you too, but still they ask. First is to elaborate the IRDA guidelines on treasury audit and systems audit of insurance company.
Okay. So there is a separate audit called IRMS audit, which is mandated by IRDA. So every insurance company should get done the IRMS audit, and there are eligibilities for this audit also. Now, this is not part of the statutory audit. However, as part of the statutory auditor, because the systems are complex and as per the statutory, the standards of auditing, we are required to involve IS auditor to do the ITGC testing, that is the user management, change management, system management, and overall changes as such. And then there are multiple applications. As I said, financial system may be different. The policyholder application may be different. So we need to identify, and the claims management may be different. So we need to test all these for authenticity, as well as the overall ITGC and the report generation, that is the IP, what we call. So all these things will have to be tested completely, so that the data that comes out from that is reliable, and we are able to process that data in terms of the audit.
And ma'am, the next one is, what are the legal requirements for conducting statutory audit of a general insurance company? Have already been majorly covered.
Yeah, I think I have put it in the slide two slides
Exactly.
on the eligibility. That is from
And
the appointment of auditor regulation itself.
Exactly. And the auditor of a public sector insurance company rely on the report of regional auditors. What is the format of reporting for the regional auditors?
Now, format of reporting for the regional audit. So PSU insurers have division concept, region concept, and then zone concept generally. So divisions get collated, branches get collated into divisions, divisions get collated into zones or regions, and then regions get collated into the main insurance company. Now each company has developed its own bits and pieces on what is it that they want from the branch. For example, premiums, mostly branches are nothing but premium hubs. So either a claim intimation comes to them or premium is collected by them. Reinsurance is not done by them, it's done by HO. Claim processing is generally done by divisions or by the zones. So there the zones will have claim data. Branches will have only premium data. And IBNR, INER, actuarial, all that gets calculated only at HO. So each stage also has some responsibilities, some different responsibilities. EOM, overall ratio, solvency, everything gets calculated at HO. So what you collate from the other places is only business data. Even investment decisions are done at HO. Branches don't do investments because that is driven at the center level. So the data that you are collating from down the line is more business data. That is either premium or claim intimation. That there is no specific format. Each one has developed their own formats.
Actually, another question is also related to this. The regional offices are only preparing the trial balance. And how will the regional auditors report on it?
Okay. In terms of report, so I have also done regional and divisional audit of insurance. So what we have done over there is that we have drawn the report as per SA 700 only, but then we have put a very clear note saying that this is only for the region, and then we also have said that certain aspects cannot be reported here because those things do not exist in the regional office. That is how we have modified that report to include these things in the form of an EOM or a note or the other matter as the case may be, and we have provided that report. Because to generate UDIN, I need some report, right? I can't generate it on the basis of trial balance.
And the next one is, ma'am, is there a LAFAR for general insurance? Just like in the banks, we have to fill up the form.
There is no LAFAR. There's no LAFAR. However, the audit report is enough. More than LAFAR.
Exactly. And they are asking in the tax audit of a general insurance company, what income is to be considered?
Okay. Tax audit of general insurance company section, the business sections, that is 32 to 45, does not apply to insurance companies. There is separate schedule to Income Tax Act where there is how the income is to be recognized is written. So the income that is considered over there is net profit as per P&L, and after that the UPR PDR will have 50% allowance every year and things like that. DTA is also quite typical in terms of those because there are no disallowances per se. It's the actually it's perfectly speaking, it's the actuarial surplus that is the profit ultimately, which gets charged based on that schedules to Income Tax Act. So you can't look into the Income Tax Act for taxability of insurance company. You have to look into the schedules for the taxability.
Now the next is for stock loss claims, the surveyor submit a trading account. If no stock records are available, what precautions can the auditor take in these cases?
So it's a surveyors and loss assessors report has to be taken as a basis. You cannot go and verify the stock losses. So whether the surveyor and loss assessor is doing appropriate work is something that you have to see, and then you have to look at the due diligence and the systems that are applicable to the surveyors and how the company is running the system. If there is a process flow in terms of how the surveyors are working, then that becomes a non-compliance with the surveyors and loss assessors regulation.
Yeah, exactly, ma'am. Another question that pop up in the mind is the role of a surveyor in case of a fire insurance or motor insurance, and the auditor role vis-a-vis a surveyor's report.
You have to take the surveyor's report. Now, don't take anything at face value, obviously. However, you have to evaluate whether it is appropriate or not, and then you have to conclude, but you do not have a responsibility to determine the loss yourself.
Exactly. And the next is, in the case of solvency margins, can we go by the certification made by the appointed actuary and the valuation actuary, since the valuation is calculation is highly technical?
No, solvency margin, certain aspects are valued by actuaries, but overall solvency margin calculation, you have to go by the regulation and you have to see the additions, deletions. In the additions, deletions, one of the items will be valuation by actuary, which you will have to take at par value. However, all other additions, deletions, you will have to verify.
And whether concurrent audit is mandatory as per regulation, and if so, what is the role of concurrent auditors?
Concurrent audit of investment, in case you are having ULIPs, or you have even otherwise wherever you have investments more than I think 500 cr, then concurrent audit is mandatory for investment. Here the concurrent audit is not for all the areas. So there is internal audit, then there is concurrent audit, then there is IRMS audit, then there are two more audits as mandated by IRDA. Concurrent audit is only for investment area, and there are certain qualifications, and then concurrent audit is again a checklist based thing which you will have to do. And if you have ULIPs, then it is every day you will have to check the NAV morning and evening, and then you will have to generate the report as same like mutual fund.
Great. And the last one is, ma'am, the scope of AS 29 contain an exception, those arising in insurance enterprises from contract with policyholder. Whether the provision for legal cases is covered under Accounting Standard 29 in case of health insurance company. However, Part 3 of Schedule B of IRDAI regulations state that the company should make provision for damages under lawsuits, where the management is
Yes.
of the opinion that the award may go against the insurer. The aforementioned regulation is silent on the procedures for accounting with respect to this. So they want
Yeah,
to
it is
ask.
a combination of both. AS 29 principles of AS 29 come into play. You have to do the PPR analysis, possible probable remote analysis. That is what you have to get it done. Independent confirmations you will have to take, and wherever there is a probable case, the provision will have to be made. That is what I explained by way of example, that if you have 500 claims, maybe company is making on average basis, you need to understand what is the average per case and how it is determined, and you have to speak to some of their legal counsel or the independent lawyers for this. Principles of AS 29 has to be definitely applied here, goes without saying, and disclosures will have to be as per IRD.
And now, what would be the right sample size for audit of claim paids and provisions for outstanding claim?
It is largely a control based audit. If you don't do control verification, it is difficult. Whatever number of sample you take, you may not be satisfied. However, you do your control testing on the basis, because this is a significant risk area maybe, and you will have to do a good control verification. After control verification, after IS audit, then you come to your sample selection. Various sample calculators are available in the market. You can use anything, IDEA, ACL, anything, any of these tools, because these have huge number of data. It is ideal to use some tool to extract the samples and also run these samples through this, because you can't fit them into the Excel at all because the number of line items are too huge. So I would advise you take some help of some tool to generate these samples, and then you can do random number sampling, you can do MUS sampling, monitor unit sampling, anything based on the tool. If you want to do physically, then you will have to develop a calculator, and then you will have to put some assurances, and then you will have to take that out.
I think queries are over, ma'am. And I must say you have excellently handled all the queries and insightful deliberation indeed. So, sir, any more question with you also?
No more questions, sir. No more question, madam.
Okay. So thank you so much, ma'am, for sparing your time. And last but not the least, thanks for all the, the audience which are with us till the last and putting all the queries to showing their interest over here on this topic. And thank you, ma'am.
I'm glad
Thank you,
that I've been helpful, and thanks for the
so much, ma'am.
opportunity, Anil sir, as well as Sonia ma'am.
Thank you so much, ma'am, on behalf of Auditing and Insurance Standard Board of Institute of Chartered Accountant of India, for sparing your valuable time. More than 2,500 members are live, madam, at at this particular moment for such a wonderful deliberation. And so many members are asking to repeat this webinar once again, because topic is very vast, and there are so many queries. And thank you so much. You have covered all the aspects of relating to the auditing, relating to this topic. Thank you so much, ma'am, for your wonderful deliberation. I also
Thank
extend
you
my
so much.
highest thanks towards the past chairperson, madam of the Jalandhar branch, who has spared her valuable time for moderating this webinar, and staying with all of us for complete 2 hours. And thank you so much for giving your kind consent in spite of having your busy schedule, madam, for our WSB webinar. Thank you
Always,
so
always. Thank you,
Always.
sir.
Thank you
Thank you
so
so
much.
much.
Thank
Bye.
thank you so much, ma'am. Namaste. Namaste. Thank you.